Hi everyone, I'm David Scranton and thank you for watching. Because today we're talking about interest rates and what higher rates could mean for everyday investors, particularly those at or near retirement. And to help us out with this also important topic is today's guest, Matthew Johnson. He's the president of Johnson Wealth and Income Management, a retirement income store in Iowa. He's also the host of the Capitalized Life YouTube channel, so make sure you subscribe to his channel. Matthew, always great to have you here.
Hey, thank you for having me, Dave.
So do your clients really understand, you find, not your clients, because you spend a lot of time educating your clients, but let's say prospective clients that sit with you for the first time, do they really understand the impact of interest rates going up and why it's happening right now?
Well, I would say that they do. I would say that being from an agricultural state, it's still kind of very much in the forefront of their minds what the 1980s and 1990s was like. We had interest rates at 18%, and it was absolute hyperinflation. So when you think about inflation, the biggest concern that I see or that I hear every single day is that possibility that it might get back to hyperinflation, which everyone is scared of.
So, I know to some degree farmers have a built-in inflation hedge because especially if the cost of food goes up, they can pass some of those costs on to the consumer within reason. But how about those in your area that are trying to plan for retirement in a traditional way using financial assets? How do you encourage them to deal with the impacts of inflation?
Well, it is absolutely true that there's not nearly as many farmers as there used to be. Sure. And so I would say a vast majority of my clients are not the farmer. They're the person that has worked in the office, or they've worked in the factory, or they've owned their own small business. And it's a big concern for them because they realize if their dollar is not going as far as a dollar used to go, what are they going to do? Well, the old conventional thinking was if you want to combat inflation, you have to put your money into the stock market, right? The stock market's always a good inflation hedge. But right now we're seeing the opposite of that, right? We're seeing that prices are skyrocketing. We're seeing that the stock market's extremely volatile, and people are second guessing that conventional thinking. So in my mind, when a person realizes that inflation is starting to grip and they need to be able to combat that, I'm going to start with the basics. We're going to discuss, okay, do you have all of your working capital working? It is amazing to me the number of clients and the number of people today that have cash sitting on the sidelines. And I get why they have the cash, right? They're either looking for an opportunity, or more importantly, they're just plain scared. So they have this cash. They've been hoarding it. It's not doing anything. The bank's not paying them for it. So we need more income when we're in an inflationary environment. So what are we doing to get that working capital working? So I make a real emphasis of focusing on interest, focusing on dividends, outside of things that are bank-like instruments, things that are more fixed income like bonds and preferreds, things of that nature that are going to provide some working capital output. And that's super important when we're in an inflationary environment.
Well, you're right. Even more with the stock market, it's really a myth that the stock market's a great inflation hedge, as Warren Buffett said recently. And it's just simple, but it's true. For some reason, I say it, you say it, people don't necessarily listen. Warren Buffett says it, actually people listen, which is a good thing. But he said, when interest rates go up, all financial assets become worth less. And he said stocks, bonds, and even farmland, I think he mentioned in there, becomes worth less mathematically because it's a higher discount factor. So there really is nowhere to hide. It's a question of, you're right, getting your money working for you in every way possible. So Matthew, let's pivot for a moment to the economy, because Mohamed Al-Erian has come out recently and said something that you and I have been talking about for a while, is that he's a little worried about stagflation, that if the Fed acts too aggressively in raising rates, because they're kind of behind the curve, they're a little too late, that they can snuff off economic growth, but not necessarily solve the entire inflation problem, because they can't solve the supply chain side. So now you've got no economic growth and inflation, which is even worse than having inflation with economic growth. So are you still in that camp where you see that as being a concern moving forward?
And I really do. There is so many different things that are dynamics right now. I think it's absolutely true what you said. The Federal Reserve cannot fix the supply side, right? The only thing that they can do is influence the demand side. And the Feds are responsible for keeping this economic car on the road. They don't want it sitting on the sidelines. They don't want it stalled. But on the flip side of that coin, they don't want it barreling down the road, becoming dangerously overheated either.
Right.
Did they wait a little bit too long? I believe that they did. Do they have some time to make up? Yes, they do. But throw this whole Russia and Ukraine thing in, and now it really kind of complicates the matter. So I would agree that we want to be super, super careful of raising interest rates too quickly by too much, because if we do that, we very much could cause our own recession, and we don't want that. I think that his concern is the economy. I don't think his concern is the stock market. I think as investors, we should be concerned about both, because obviously economically we have to pay for things, and investment wise, we may have money in the market. But if we turn the clock back to 2018, we watched 4 rate increases. In the first 3, we were like, okay, yeah, maybe we'll accept that. The 4th one, it was all bets off, and the stock market drops by nearly 20%. And here's what we have to remember. Anytime the market goes down, it costs us more than money. It costs us time. And that time is worth something. We have to wait for those dollars to come back. So this is the reason why diversification is so vital when you're investing for retirement.
Okay. So you mentioned Russia and Ukraine. So we'd be remiss if we finish this interview without talking about it. How is this going to affect things? How is this going to affect inflation, in your opinion? How is this going to affect the Fed's decision? Give us your thoughts on that.
Well, I don't know that the Feds have a choice. I think that the Feds are going to have to do this first rate increase, despite what's going on. I think that if anything, inflation could be influenced or pushed even a little bit higher if this whole mess with Ukraine and Russia continues on, because it's just going to create, more demand for certain things. And we also know that it's going to affect corporations, because there is corporations that are trying to get behind in unity to say, we're going to impose our own personal sanctions on Russia. And in many respects, we're going to see some corporate profits go down. That's not going to look good. The only person that sanctions are really hurting, I think, at this point is the poor potato farmer, the average civilian within Russia. So it's a very delicate dance. We've got a lot of balls in the air that are being juggled right now, and we've got to keep our eye on the prize, which is, what is our outcome? And if our outcome is to try to protect ourselves and to try to combat inflation to the best of our ability, this is, I believe, where working with a fiduciary is so very vital. Having a plan, following the plan, keeping your hands to the plow, being diversified, and focusing on income.
Yeah. So even though you're right, the whole Russia-Ukraine situation could make inflation worse, can actually hurt our economy, certainly can hurt corporate profits in the stock market. At the end of the day, your average investor, there aren't really any major changes that they should be making because of this, at least at this point. So have a plan and work your plan. I love it. Good advice as usual. Matthew, thank you.
Thank you, Dave.
Thank you for watching today's video. What's up with interest rates? If you enjoyed it, click the thumbs up button to give us a like, and make sure that you subscribe to our YouTube channel for new content each and every week.